Hello everyone. Today with Group B, we're going to present about the chapter 13. It's called Current Liabilities, Provision and Contingencies. Before we present that, I will introduce our group members. There is Janice Marella P with last digit MPM 251, Talitha Novia R with last 3 digit MPM 358, Ignatius Ardino Miskha with last 3 digit MPM 121. Next is Prita Luneta K with last 3 digit MPM 171, and the last is myself, Nabilah Nur I with last 3 digit NPM 096. At first, I will explain what is current liabilities. So, current liabilities is a liability that present obligation of the company to transfer economic resources like cash, goods, or services due to the past events. The liabilities are divided into two: is current liabilities, or it means a short-term liabilities that only 1 year operating cycle, and the second is non-current liabilities, that is long-term liabilities. Liabilities is considered current if will be settled within the company operating cycle, or it's due within 12 months or 1 year after the reporting date. The operating cycle is mean the time from buying goods or services to collecting cash from sales. Some industries like manufacturing industry have longer cycle. Even if the payment is beyond 12 months, it can still be in current if it falls within the operating cycle. The next is the example of the current liabilities. First one is account payable. It's a amount that owed for goods or services both on credit. Usually account payable in a short term, usually it's 30 to 60 days, and record when the ownership of goods transfers, not necessary when it's paid. Account payable are so measurement it's straightforward based on invoice amount. The next is notes payable. Notes payable is a payable that written promises to pay a specific amount in the future. There is two types of notes payable. The first one is interest bearing notes. The interest bearing notes mean notes that include state interest rate. Also, the interest is recorded over time or accrual. At the maturity, the interest bearing note is will get a pay principal plus interest. The next is zero interest bearing notes. It means that notes that no have explicit interest rate. It's not that actually include implicit interest or discount. Also, it's recorded at present value with interest recognized over time. The next example is current maturities of long-term debts. It means portion of long-term debt due within the next year and report as the current liabilities exception, as you can remain on current if the refinance with long-term debt or convert into shares. And if the debt become payable on demand, for example, is due to violation of agreement, it must be classified as current. The next example is short-term obligation expect to be refinanced. It means that a short-term obligation debts that a company plans to refinance into long-term debt. The short-term obligation may be classified as non-current if certain conditions are met. The condition is like intent and ability of the company. So short-term obligation is avoid using working capital in the near term because working capital is current asset minus with current liabilities. So if the debt is refined to no cash, is if the debt is refined, there's no cash is used soon and current asset will not reduce.
Hello everyone, my name is Talitha Novia R, and today I will explain about dividends payable and unearned revenue. As we can see on the slide, we will discuss three important types of liabilities in accounting. Let's break them one by one. So the first one is dividend payable. So what is this? Simply, simply put, it is the money that a company owes to the shareholders. When does it become a liability? It becomes liability immediately after the board of directors officially announce, like, we will pay dividend. An important study note here: dividend payable is classified as currently liability. Why? Because the company always pays this amount in cash within a single year. The second one on the right side is customer deposit. Sometimes company asks the customer for a cash deposit. This is usually done to guarantee a service to cover potential damage. For example, when renting something, why do we record this as liability? Because the company doesn't own this money permanently. The company will likely have to give this money back to the customer later. That's why it sits on the liability side. And the third one is unearned revenue. So we discuss it. This topic we have the golden rule. If you get the money before you do the work, it is liability. This is because you owe the customer a product or a service. Let's look a process. Sorry. Let's look at the process shown in the diagram. Step 1, the company receives cash from the customer. Since the work is not done yet, we must record it as liability. And the second step is after the company actually provide the service or deliver the product, we can finally record it as revenue. Thank you. So we move to the next step, that's taxes payable. So, as we know, business don't just earn the money. They also have to handle taxes for the government. On this slide, we will look at three common types of taxes. First, sales tax, value added tax, and income taxes payable. Let's look at them one by one. The first one is sales tax. Let's look at the left side, sales tax. To make it easy, think about when we buy groceries at supermarket. When we pay at the cashier, the supermarket collects tax from us. But here is the trick: it is not their money. The supermarket owes this money to the government because they have not paid it to the government yet. So they must record it as sales tax payable on their books until they finally transfer the money. The second one is value added tax. Let's look at the right side, or commonly known as VAT. What is VAT? It is a tax added at every single step of making a product. If you look at the diagram, you can see the journey of making bread. It starts with the farmer who grows the wheat, then it goes to the baker who makes the bread. After that, it goes to the supermarket to be sold. At each step, value is added and tax is collected. But don't worry about the business. They actually get a credit for the VAT they already paid to the supplier. So who really pays the VAT at the end? Look at the yellow note at the bottom. Yes, you or us, the final customer, is the one who bears the final tax burden when buying the product. And the third one is income taxes payable. So the bottom section is the explanation of that. Unlike sales tax or VAT, which depend on shopping, this tax is based on what the company earns. Company must pay taxes on their annual net income or their yearly profit. Here is fun fact. Did you know that the accounting income, which is the profit number you can see on official financial report, and taxable income, the number calculated for the tax office, can actually be different number. Why? Because the accounting world and the tax office use different set of rules to calculate the profit. So let's move on our next topic, employee related liabilities. This slide talks about the money a company owes because because it employs people. We can divide this topic into two main parts: payroll deduction and taxes at the top, and compensated absence at the bottom. Let's look at the detail. First, payroll deduction and taxes. Let's start with it. Did you know that a company doesn't actually give employee 100% of their gross pay? Of course, you know that. As you can see from the paycheck illustration, the company cuts or withholds some money from the employee salary. They withhold money mainly for two things. The first one is income tax withholding. This is the tax taken straight out of the paycheck to the given to the government. And the second one is social security tax. This is the employee share of money paid to the government for future retirement and medical benefit. Why is this a liability? Because the employer is holding into this money temporarily. The employee must report this amount as liabilities until they are finally sent or remitted to the government. So the second one is compensated absence. In simple terms, it is paid time off. It covers things like vacation day, sick leave, and maternity off or paternity leave. But how does a company record this in counting? Well, it depends on the employee's right. There are three types of rights shown in the sticky note. First one is vested right. These are guaranteed days. Even if you quit your job today, the company must pay you cash for this unused day. In accounting, this is recorded or accrued as liability immediately. Second one is accumulated right. This think of this as a rollover system. If you don't use your leave day this year, you don't lose them. You can save them and use them for next year. Because they roll over, the company must also accrue this as a liability. And for the last one is non-accumulating right. This is a use it or lose it system. This day do not carry forward to next year. Therefore, the company has no liability until the exact day the employee actually used the leave.
Okay, for the first material is compensated absences. It's like paid absences from employment, such as vacation, illness, and maternity, paternity, and jury leaves. The first one is vested rights. This rights is exists when an employer has an obligation to make payment to an employee even after terminating his or her employment. So then second one is accumulated rights are those that employees can carry forward to future periods if not used in the period in which earned. The last one is non-accumulating rights. So these rights is do not carry forward, they lapse if not used. As a result, a company does not recognize a liability or expense until the time of absences. So the company record as benefit. Okay, this is the example. Amutran and V began operation on January 1st, 2022. The company employs 10 individuals and pays each €480 per week. Employees earn 20 unused vacation weeks in 2022. In 2023, the employees used the vacation weeks, but now they each earn €540 per week. So they change the earn per week. And then the Amutran accrues the accumulated vacation pay on December 31st, 2022 as follows like this. The salaries in which expense is on the debit side, and then the salaries in which payable on the credit side. And the amount is from the first pay, which is 480 per week. We multiplied by 20, which is the unused vacation weeks in 20 and 22. So the result is 9,600 euro. And then at December 21st, 2022, the company reports on its statement of financial position a liability of 9,600 euro, And then in 2023, it records the payment of vacation pay as follows, and the salaries in which payable have the same amount like before, which is the 9,600 euro, and then the salaries in which expense is one 1,000 1,200 euro, and cash is 10,800 euro. Where is come from the cash is from five. The second page on the 20 and 23, they said the employees each earn 540 per week. So we multiply with 20. And then the result is 10,800. And then if we want to found if we want to find the salaries and wage expense amount is just cash minus with the salaries and wage payable, like that. The next one, we talk about the profit sharing and bonus plans. So, a company may consider bonus payment to employees as additional salaries and wage and should include them as a deduction in determining the net income for the year. And to illustrate the interest for an employee bonus assume that Palmer Inc. shows income for the year 20 and 22 of $100,000. It will pay out bonuses of 10 10,000 and $700 in January 2023. Palmer makes an adjusting entry dated December 31st at 20 and 22 to record the bonuses as follows, like the sellers and which expense on the debit side and the sellers and which payable on the credit side, same as before. And then the amount is 10,700 dollars, and then the same as the credit side. And then in January 20 and 23, when Palmer pays the bonus, it makes this journal entry, salaries and which payable on the debit side and the cash in the credit side, because we pay our payable, so our cash will decrease. And then the amount is same as before, 10,700 dollars. So the liability, salaries and wage payable is usually payable within a short period of time. Companies should include it as a current liability in the statement of financial position. And then similar to bonus agreement are contractual agreement for conditional expenses. So conditional expenses based on revenues or units produced are usually less difficult to compute than bonus arrangements. And this is the example. Assume that a lease calls for a fixed rent payment of $500 per month, and 1% of all sales over $300,000 per year. The company's annual rent obligation would amount to $6,000 plus 0.01 dollars each dollar of revenue over $300,000. And the other example is like a royalty agreement may give to a patent owner $1 for every ton of product resulting from the patented process, or give to a mineral rights owner $0.50 on every barrel of oil extracted as the company produce or extract each additional unit of product. It creates additional obligation, usually a current liability. Okay, for the next one, we will talk about provision. So, provision is like a liability of uncertain timing or amount, and then sometimes referred to as an estimate liability. For example, patronage. Malaysia, reported linked Malaysia 35 and 266 million related to a provision for the commissioning oil and gas properties. Nokia or Fin reported 195 euro million for warranties, intellectual property infringement, and restructuring costs. And Ande Quagro SA reported as 3.6 and 20 million for labor, legal, and other claims. So this is the recognition of a provision. So the companies accrue an expense or related liability for a provision only if the following three conditions are met. The first one is company has a present obligation like legal or constructive as a result of past events. The second one, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. And the last one is a reliable estimate can be made of the amount of the obligation. So if these three conditions are not met, so no provision is recognized. And then this is the example for the provision. The first one is warranty. This one is warranty. So the fact is Santos SA gives warranties to to the sale of its electrical products. The warranties are not for 3 years from the date of sale. Based on the experience, it is probable that there will be some claims under the warranties. So the question goes like this. Should Santos recognize the statement of financial position that a provision for the warranty cost to be settled? So the first solution is the warranty is a present obligation as a result of past obligating even is the sale of the product with a warranty which give rise to a legal obligation. The second solution that there will be some claims related to these warranties, and then the Santos should recognize the provision based on the past experience. And a constructive obligation is an obligation that derives from a company action whereby an established pattern of past practice, published policies, or a sufficiently specific current statement the company has indicated to other parties that it will accept certain responsibilities, and as a result the company has created a valid expectation on the part of those other parties that it will discharge those responsibilities. The next one is refunds. So this refund is demonstrate how a constructive obligation is reported. And the last one is lawsuit. The lawsuit is presents a situation in which the recognition of the provision depends on the probability of the future payment. Okay, for the next, we will talk about measurement of provision. It's still a part of provisions. Okay, the amount recognized should be the best estimate of the expenditure required to settle the present obligation. So here is how this judgment might be used in three different types of situation to arrive at best estimate. The first one is Toyota warranties. Like Toyota sells many cars and must make an estimate of the number of warranties, repairs, and related costs it will incur. Then second one is Carrefour refunds. Carrefour sells many items that varying selling price. The- So the last one is Novartis lawsuit. Large company like Novartis are involved in numerous litigation issues related to their products. So we will talk about still measurement of provisions. And then here's a common areas all for which provision may be recognized in the financial statement. The first one is lawsuit, warranties, considering payable, environmental, onerous contracts, restructuring, and then this is the first the one is litigation provision. Like companies must consider the following factors, among others, in determining whether to record a liability with respect to pending or threatened litigation and actual or possible claims and assessments. The time period in which the underlying cause of action occurred and the probability of an unfavorable outcome. And the last one is the ability to make a reasonable estimate of the amount of loss. So, to recognize litigation loss and liability, the event causing the lawsuit must have occurred on or before the financial statement date. Companies assess the likelihood of an unfavorable outcome by considering factors such as the nature and progress of the case, legal counsel's opinions, past experience, and management's response. For unfilled or uncertain claims, companies must evaluate both the probability that a claim will be filled and the probability of an unfavorable outcome. And this is the second one is warranty provision. A warranty, like product warranty, is a promise made by a seller to a buyer to make good and deficiency of quantity, quality, or performance in a product. Manufacturers commonly use it as sales promotion technique. The companies often provide one of two types of warranties to customer. The first one is assurance type warranty and the second one is service type warranty. Okay, we will next to the material, which is the first type of warranty. The first one is assurance type warranty. So warranties that guarantee a product will function as intended and be free from defects at the time of sale. They provide assurance about the quality of the product rather than an additional service. It's like currency like that. So for the example, is Denson Machinery Company begins production of a new machine in July 2022 and sells 100 of this machine for $5,000 cash by year and for a total sales revenue of $500,000. We multiplied what with the 100 with the $5,000 and each machine is under warranty for 1 year. So the garansi itu 1 tahun. Then Sun estimates based on past experience with similar machine that the warranty cost will average $200 per unit for a total expected warranty expense of $20,000. So we multiplied 100 with $200. So further, as a result of part replacement and services performed in compliance with machinery warranties, it incurs $4,000 in warranty costs in 2022 and $16,000 in 2023. So the question is, what are the journal entries for this sale and the related warranty costs for 2022 and 23. So this is the solution on the right side. You can see the solution for the sale of the machines and related warranty costs in 20 and 22. The interests are as follows. The first one, to recognize sales of machines. So July until December 20 and 22, cash and on the debit side and sales revenue on the credit side. The amount like the total sales revenue of $500,000 it's from 100 multiplied by $5,000. So second, the record payment for warranty expenditures incurred in 20 and 22. So warranty expense on the debit side, cash inventory, accrued payroll is on the credit side. The amount is $4,000. And the third one, the adjusting entry to record estimate warranty expense and warranty liability for expected warranty claims in 20 and 23 is warranty expense is $16,000 on warranty expense in credit debit side, and then warranty liability in credit side the same amount. And as a consequence of this adjusting entry at December 31st, 20 and 22, the statement of financial position reports a warranty liability, uh, a current liability of $16,000 is from $20,000 minus with $4,000. And then the income statement for 20 and 22 reports sales revenue of $500,000 and warranty expense of $20,000. And the last one is to record payment for warranty expenditures incurred in 20 and 23 related to 20 and 22 machinery sales. So the warranty liability on the debit side. So we menukar like that. Cash inventory accrued payroll is still on the credit side. The amount is $16,000. So at the end on the 2023, no warranty liability is reported for the manufacturer like that.
Hello, my name is Prita Luneta K with last 3-digit MBM 171. In here, I will explain about the service type warranty. So, a service type warranty is an extended warranty or a maintenance contract that is provided extra protection, coverage, or maintenance beyond the manufacturer's basic warranty. So, a companies record a service warranty as a separate performance obligation. Like example, in the case of the television, the seller recognition the sale of the television with the assurance type warranty separately from the sale of the service type warranty. The sale of the service type warranty is usually recorded in an unearned warranty revenue account. I give you example in here. So you purchase an automobile from Hamlim Auto for 30,000 on January 2022, and Hanlim estimate the assurance type warranty cost on the automobile to be 700, which is Hamlim will pay for repair for the first 36,000 kilometer or 3 years, whichever comes first. So the Hanlim will pay the first 3 years, and you also purchase for 900 a service type warranty for an additional 3 years or 36,000 kilometer. So you also purchase 900 service warranty for 3 years after the 700 warranty. So in the first 3 years, the Hanlim will uh, warranty your automobile, which is you already paid the 700 is included in the 30,000, and then you also purchase 900 service warranty, which is will apply after first 3 years. So it is applied when it's come in four till 7 years. at the front, yes. And then Hanlim incurs warranty costs related to the assurance type warranty of 500 in 2022 and 200 in 2023 and 2024. Hanlim records revenue on the service type warranty on a straight line basis. So the question is, what entries should Hanlim make in 2022 and 2025? So first, we will record the sale of the automobile and related warranties on 2022, which is when the automobile is being buy or sold. Okay. So in the debit side, we have cash in here. The amount is 30,000, 30,000 and 30,900. It's come from 30,000 is the cost of the automobile, and then the 901 is from the service warranty that the customer is purchased. And then on the credit side, we have the unearned warranty revenue and sales revenue, which in the unearned warranty revenue, we got the amount 900. Meanwhile, in the sales revenue, we got the amount of 30,000. After that, we will record warranty expenditure incurred in 2022. So in the debit side, we have warranty expense, which is 500 500. And then in the credit side we have cash, inventory, and accrued payroll account with the amount 500. And then also we will record the adjusting entry to record estimate warranty expense and warranty liability for expected assurance warranty claims in 2023. Yes. So in the debit side, oh my god, I'm sorry. So in the debit side, we have account warranty expense for 200. Meanwhile, in the credit side, we got the warranty liability with the same amount, which is 200. It is got from uh you know the first warranty that included in the 30,000 is 700, right? So in the 2022, we already are we already expenditure, we already feel the benefit for 500. Okay, 500. So the leftover of the warranty is 200, which is cut from 500, 700 minus 500, and then we got the leftover is 200. And then we also record a revenue recognition in 2025 on the service type warranty. So in the debit side, we have unearned warranty revenue for 300. Meanwhile, in the credit side, we have the warranty revenue for the same amount, which is 300. 300 is got unearned warranty revenue with the amount 300 is got from 900. 900 divided by 3. So 900 is the service type warranty amount that the customer already purchased. Meanwhile, the 3 divided by 3 is the useful life of the service type warranty that the customer purchased. So 900 divided by 3 years or 3 is we got the 300. Yeah, that's why in the unearned revenue we got 300. Okay, next we will talk about the consideration payable. So the companies often make payment or provide consideration to their customer as part of a revenue arrangement. Consideration paid or consideration payable, it include like a discount, volume rebates, free product or service, and etc. And next is environmental provisions. So environmental provision is referred to either mandates corporate funds reserved for future environmental liabilities, like example is pollution cleanup, or a specific legal clause designed to protect ecological system. So a company must recognize an environmental liability when it has an existing legal obligation associated with the retirement of a long-lived asset, and when it can reasonably estimate the amount of the liability. Like example is what I mean is the example of existing legal obligation that require recognition of a liability includes but are not limited to decommissioning nuclear facilities, disma- dismantling, restoring, and reclamation of oil and gas properties, and then certain closure, reclamation, and removal costs of mining facilities, and then next is closure and a post-closure cost of landfills. A company initially measure an environmental liability at the best estimate of its future costs. The estimate should reflect the amount a company will pay in an active market to settle its obligation or essentially fair value. So, to record environmental liability in the financial statement, uh, a company includes the costs associated with the environmental liability in the carrying amount of the related long-lived asset and record a liability for the same amount.
Next, we will talk about the onerous contract. It is the cost of meeting the obligations except the economic benefit expected to be received. So the expected cost should reflect the least net cost of exiting from the contract, which is the lower of the cost of fulfilling the contract or the compensation or penalties arising from failure to fulfill the contract. Like the example, we assume that Smart Sport uh, operates profitability in a factory that it has leased and on which it pays month rents Monrental Smart decided to relocate its operation to another facility. However, the lease on the old facility continues for the next 3 years. Unfortunately, Smart cannot cancel the lease, nor will it able to sublet the factory to another party. The expected cost to satisfy this onerous contract are 200,000. In this case, the smart company will make the journal entry uh, loss on lease contract in debit for 200,000 amount, and then in the credit side there are lease contract liability for 200,000. And then next is restriction provision. So restriction are defined as program that is planned and controlled by management
and materially change either in the scope of a business undertaken by the company or the manner in which that business is conducted. Like the example is the restriction are the sale of a line of business, change in a management structure, such as eliminating a layer of management or the closure of operation in a country.
Alright, continuing for my friend, I'm now going to be explaining about self-insurance. Firstly, is that financial reporting rules prohibit companies from recording liabilities for general risks, such as potential loss from for future economic condition. Similarly, liabilities cannot be recorded for specific future risks like expected future repair allowance. And with the past transaction requirement is that items do not qualify as liabilities because they do not stem from past transaction, but instead relate entirely to future event. Self-insurance itself, self-insurance itself is not a real insurance, but more like a risk assumption, where some companies do not purchase insurance policy against fire, flood, storm, or accident because the risks are uninsurable, rates are too high, or they choose to assume the risk themselves. And there is also the way of cognition threshold where even if company has sustained continuous past losses, a liability is not recognized if no asset has been impaired or no actual present obligation has been incurred at the reporting date. Lastly, provision disclosure, where when company do report provision, for example, for restructuring, warranties, litigation, or environmental costs, they must also provide detailed note disclosure showing a full reconciliation of changes from the beginning to the end of the year. Okay, nextly I'm going to be explaining about accounting for loss and gain within contingency. Contingency itself is event or something that is moreover a scenario where it is characterized by high level of uncertainty where regarding eventual financial gain or losses, which is be confirmed only if that event is occurring or not. And within contingency itself, there is two things. Firstly is liabilities and asset. And firstly is liabilities, where liability itself, contingent liability itself, are not recognized in the financial statement because firstly is that there is a possible obligation or not yet confirmed as a present obligation. Secondly, a present obligation for which is not probable that payment will be made. Thirdly is that there is a present obligation for which a reliable estimate of the obligation cannot be made. And for the guideline for contingent liabilities is unless there is any outflow in the settlement or it is removed, companies should disclose the contingent liability at the end of the reporting period, providing a brief description of the nature of the contingent liability itself and where it is perishable, which is firstly is an estimate of its financial effect. Secondly, an indication of the uncertainties relating to the amount of timing or any outflow. Thirdly is the possibility of any reimbursement. Moving on, now I'm going to be explaining about contingent asset. It is a possible asset that may come from past event and whose existence will be confirmed by the happening of or occurrences or non-occurrences of a certain future event that is not fully within the control of the company. The common contingency asset are firstly is receipt of monies from gift, donation, and bonuses. Secondly is refund from government in tax dispute. And thirdly is pending court cases with a probable favorable outcome. And with determining this contingent asset, there is also the guideline. which is as follow. Firstly is virtually certain, or there are more than 90% possibility where the item itself no longer considered contingent and must be recognized as an asset on the statement of financial position. Secondly is probable, or 51% to 90% probability of happening, where the item is not recognized as an asset but must be disclosed within the financial statement note. And finally is the possible, with the range of 5% to 50% probability, or remote, where it is less than 5% probability. And because of that, the item itself is doesn't need to be noted or being disclosed, where the note itself is not permitted or required. Okay, lastly is the presentation and analysis of current liabilities. For the presentation guidelines itself, that is firstly that supplementary information must be comprehensive and enough to satisfy full disclosure requirement. Secondly, is that company are required to explicitly identify any secure liabilities and disclose the corresponding asset pledged, as a collateral. And lastly is that current liability are typically reported at their full maturity values and can be arranged later by maturity date, amount, or liquidity preference. And after the presentation is the analysis itself of the current liabilities with the use of liquidity ratio. There is two types. Firstly is the current ratio. As you can see, the formula is bisa rate. It is frequently also called as working capital ratio. For the function itself, it serves as an overarching coverage check but does not indicate whether a dangerous portion of short-term value is locked away in a slow-moving illiquid inventory. Secondly is acid test or quick ratio, and the formula is in Bisarit. As you can see, it provides a strict diagnostic tool for immediate solving by entirely removing inventories and prepaid expense from current assets before dividing by current liabilities.